Hey everyone, I'm Jeremy Szafron. This is Kitco News. Don't forget to hit that subscribe button for the latest updates. Well, media coverage of the U.S. presidential election has reached a fever pitch following President Biden's recent announcement to withdraw from the presidential race. And just recently, former President Barack Obama and First Lady Michelle Obama threw their endorsement behind Vice President Kamala Harris. Now, this unprecedented decision by Biden to drop out of the race this late is creating significant uncertainty and market volatility. Meanwhile, next week's Federal Reserve meeting is highly anticipated as we look for signals on a potential interest rate cut. Now, the market pricing in September, but some analysts saying a July cut should happen. And the performance of corporate earnings, particularly among the Magnificent Seven stocks, is another critical area that we're going to be focusing on. How will these developments impact the market, and what strategies should investors consider in these turbulent times? Well, to unpack all of this with us is our friend Kristina Hooper. She's the Chief Global Market Strategist at Invesco. Thank you for joining us, taking the time today, Kristina.
Thanks so much for having me.
Now, as I mentioned before, we got lots to get to today. Let's start with President Biden's recent decision to withdraw from the race. We're seeing heightened market volatility. I was reading your recent notes here, and how do you anticipate that this political shift will affect investor behavior in the coming months, especially given the historical context of such a late withdrawal from a presidential campaign?
Well, I think we'll certainly see a significant amount of volatility, especially since there are likely to be more twists and turns in the next 100 or so days. I think what's really important is that investors not get spooked, because I think it's going to be very easy to do that with the kinds of headlines that we've already seen. More are very likely to come. So I think of it this way. Investors have a pretty long timeline, at least most of them do. Much longer than an election season, much longer even than a presidential term. So it's absolutely critical not to lose sight of long-term investment goals, because there's all this noise coming from the media around the election. I do think we could very well see the amplification at times of what is called Trump trades, and then the rollback of them. That's natural. It moves often with the polls or with events as they unfold. But again, it's very, very short-term in nature. So the best thing we can do is put on blinders.
Yeah, it's so interesting when you just try to think 3, 4, 5 years out, but you're constantly forced with all this news in your face. I mean, do you think that the current market reaction is an overreaction then? I mean, it seems like the market is fueled on narrative here and not so much on fundamentals.
So I think it's normal to see some kind of pullback. In fact, it's probably been abnormal for us to not have had a pullback sooner, just given how strong the rally has been for so long. I think of this as healthy. It makes sense. And it's not surprising to have it happen during earnings season. But having said that, I don't think that there is any real fundamental basis for a significant correction that lasts. I think what we're likely to see is a pullback that is rather brief. And then I think we'll see the resumption of a rally. I think we're likely to have a solid earnings season. And also we have that other catalyst of Fed rate cuts starting relatively soon.
Yeah, let's open that can of worms. I mean, the Federal Reserve's meeting next week is highly anticipated. It seems like with the recent data, we're getting closer to that 2% target that they're looking for. Given recent remarks from Fed officials about the possibility of rate cuts, what are your expectations here? I mean, the market's pricing in September, like I said, but should we see something next week?
Well, I think there's a small probability of seeing a rate cut next week. I think we should get one next week, but we're very unlikely to, although the probability of one did go up with Bill Dudley's piece the other day arguing for a rate cut in July. There are cracks forming in the U.S. economy. And if, for example, we look to Canada as a guide, the Bank of Canada has now cut twice. They are also seeing cracks forming in their economy. Now, the U.S. economy arguably has been more resilient, but we have to recognize that monetary policy has long and variable lags. So having hiked rates 500 basis points and kept them at that high terminal level for now 12 months, we increase the risks of a recession every day they stay this high. And so I think that it makes sense, especially with the progress that has been made on inflation. Seeing core PCE, the spread between that and where the Fed funds rate is very wide right now. And it's the widest it's been in a long time, since 2008, I believe. And so it is, in my opinion, time to get started on rate cuts.
Yeah, we're certainly looking at those cracks. And I mean, it would be very interesting to be Jerome Powell in this situation. I mean, some economists argue that the Fed might hold off due to the proximity of the presidential election, not wanting to be political in this scenario. But of course, that could risk the economy too. What are your thoughts here on that timing?
Well, I think Jay Powell has been very clear that he is not going to worry about the election, and the election is not going to drive the Fed's calendar. So he has articulated a real willingness to make monetary policy moves when the economy, when the data tells the Fed that it's time to do that. I think a bigger issue for the Fed is that nobody wants to be another Arthur Burns. They don't want to preside over some kind of resurgence in relatively high inflation. So they're more concerned that they haven't yet extinguished the high inflationary pressures and that there could be some kind of significant comeback they can't get under control. So I think that's the bigger concern for them.
Yeah, and I mean, how do they get it back into control? I mean, considering that core PCE inflation has cooled to an annualized rate of 2.3%, again, getting closer to that 2% he keeps talking about, does this mean that the Fed's tightening measures are working here, or is there a risk that inflation could resurge?
I think the Fed's tightening measures have been very effective. It's taken some time, but they have. We've been in a very normal environment for years. We turned off an economy like a light switch. But then we threw an enormous amount of stimulus at it, both monetary and fiscal. So we're still working through all those sort of bizarre external factors. But the reality is that it has gotten under control. Now, there are components of it that are still sticky, that are higher than the Fed would like it to be. But let's face it, things are moving in the right direction and at a fairly fast clip after being pretty stagnant in the first quarter and not seeing any disinflationary progress. So I think we're getting there. I think we will get to the Fed's target relatively quickly.
Yeah, okay, let's talk about earnings season. I mean, it's upon us. And I want to talk a little bit about what the trends you're observing in corporate performances, particularly with the Magnificent Seven. I mean, the Mag 7, as we know, are doing quite well here. Do you see signs of market performance broadening beyond these key players, given that 80% of the S&P companies have beaten earnings expectations so far?
Absolutely. I think what we're seeing is greater contribution to earnings growth from the other 493 names in the S&P 500. It's certainly greater than it was in the first quarter, and it's projected to get better as the year progresses. That's key to the market broadening in a sustainable way. Keep in mind, we also have another key driver, which is the start of Fed rate cuts. I assume that the Fed will have cut rates in time to avoid a recession and will likely have rate cuts that cause an economic reacceleration later this year, early next year. That's an argument for smaller caps, for cyclical names that haven't participated the way tech has, but are likely to now because they're, of course, the most cyclically sensitive.
Yeah, I want to get into that a little bit because do you think that this concentration of growth in a few stocks poses a risk to market stability here? I mean, what sectors do you believe? You mentioned small caps. We're hearing a lot on the Russell. What's the trade here?
So I think that there's always a heightened risk when you have a concentrated market environment, but it doesn't mean that it ends badly. It ends in one of two ways. Either the market has some kind of significant correction or the market broadens. And I think that's what we're seeing now is this broadening. And I think that can continue. I think the earnings environment will get better, especially for smaller caps, especially for cyclicals, so long as the economy doesn't go into recession. I think we will have been able to avoid a recession if the Fed acts soon and begins to cut. That will almost immediately, in my opinion, start to have an impact on the economy. And it's clearly slowing now, but I think we would see a pickup by the end of this year.
Yeah, it seems like throughout, these data being released to us from the Fed and then seeing a little bit of the revisions, consumer spending, we keep talking about inflation coming down, but the people at home are still a little bit hurting, with the latest data showing a modest increase in consumer spending and inflation. What's your outlook for the U.S. economy in the second half of 2024, especially considering that consumer spending accounts for 2/3 of the GDP?
Oh, yeah. We always have to keep in the back of our heads that the consumer drives the US economy. So it's absolutely critical to understand what the consumer's doing. And what we're getting from earnings reports thus far is the message that consumers are not spending as much as they had been, and consumers are being very careful. Lower income consumers, in particular, are under pressure, and that pressure is increasing. Um, Keep in mind, we've had a significant increase in unemployment from January through June, and that's likely to continue. So, this is an economy that is likely to slow from here. I know we got a great second quarter GDP print, but that is the rearview mirror. Looking ahead, we're likely to see a slowdown as the consumer continues to come under pressure. Of course, that can start to change if we start to see rate cuts begin soon.
Yeah, it's interesting. There was a recent note I was reading from Bank of America, I think Michael Hartnett. He was suggesting that the rally in the big tech stocks are at risks, obviously, if the U.S. economy cools down. We kind of know that. But, we talk about this rotation into stocks that have lagged behind the tech mega caps. Any names here, anything that we should kind of be looking at when we look over to those markets?
Well, I wouldn't list specific names. I think it's important to look at those companies that don't have high debt levels, but are cyclically sensitive. So, some of the materials, for example, industrials, um, actually, I should say many of them are benefiting from legislation like the CHIPS Act, which has created a massive amount of construction spending in the manufacturing space. We also have some consumer cyclicals that are poised to do better, as well as financials, if we start to see rate cuts begin and an economic reacceleration. So I think there's a lot of opportunity. I wouldn't say all 493 names in the S&P 500, but a very good segment of them. I think we're going to see a continued rotation into them. But I would also make the case that that doesn't mean that tech is going to do very poorly. It just means tech will lag, in my opinion, but there's still a lot of opportunity. It's just a longer time horizon for technology.
Yeah, I was reading your note recently, and you had a little bit of a caveat in there about China. I want to switch over to that topic because how do you view, recent developments in China, such as I think the People's Bank of China is lowering its policy rate. Of course, that's going to impact the U.S. market a little bit here. Given China's emphasis on technological innovation and reform and kind of having to put stimulus back in the market, what global implications are we going to see from this move?
Well, I think of it in terms of what it's likely to do for China equities, and I think they'll benefit from these kinds of policies. Some of the benefits won't pay off right away. I mean, I think of it as not dissimilar to the AI investments made by technology companies. Many of them make sense, but sometimes the payoff can be longer than for other policies. But I think in general, what we're seeing are policies that are very much supportive of the equity market, supportive of investing and encouraging foreign investment. So I think there's very significant potential there. And of course, also getting rate cuts from the PBOC helps. And that, of course, has a much faster impact.
Yeah, China had to pivot really quickly here. They were starting to see some huge, lack of economic data happening from that country. I'm kind of curious. Do you think that the measures that they're taking, kind of similar to the U.S., but they're doing it now in terms of this innovation on the green side, do you think that this is going to counteract the ongoing economic slowdown that's kind of facing in that country?
Absolutely. I mean, if you think about what's happening in China, what we really saw was more weakness on the manufacturing side. And I view that as a reflection on weaker global demand as opposed to telling us anything about the Chinese economy. Services was far more solid than manufacturing if we go back and look at PMIs over time. That's an area of strength. And so I think there's a lack of a real fundamental assessment of China when we focus on manufacturing, because to me that tells us more about the global environment and global demand. So I think that the pieces are in place, and I think we'll continue to get policies that are supportive of the economy. I mean, it's really interesting. You mentioned a lot of the policies, the innovation that's going on right now, that focus in China. It's not similar, as you said, to the United States. In fact, what we're seeing is a number of countries are doing more in the way of industrial policies to shape their economies. And I think a prime example is the CHIPS Act, but we're seeing that coming from the EU, and we're seeing that coming from China in terms of having a vision for what they want to see the economy look like, and the key drivers that can shape that through policy. So it's an interesting environment. I'm excited about it because I think that direction can often be very beneficial in terms of economic outcomes.
Yeah, and we're seeing that, green grid starting to take place. We're seeing this transformation of, our economy starting to take place. That must be kind of bullish here for metals and minerals as well, I'd suspect. Is that your take on this?
Absolutely. We've got two drivers for metals, for minerals, for the really materials in general. And that is that we've got that rotation going on, but also that potential for global economic reacceleration, which I think is not far off.
Interesting. And so are you positioning yourself here? I mean, if we're just talking to an investment audience, you're a macro strategist for a very large organization. You must be breathing a little bit of a sigh of relief seeing the PCE, seeing a little bit of the moderation in our economic data.
Oh, for sure. I mean, we've believed that we would see that disinflationary progress. So we love to see confirmation of theses, right? But at the end of the day, I think it's very important to also remind that while we can make tactical moves and lean into, for example, cyclicals or smaller caps, it's so important for investors to have that very long time horizon, to have an investment plan that's well diversified and stick with it. I think the biggest mistake investors make is when they get spooked and get out of markets. And in fact, right now we have an excess of cash on sidelines. Many investors are underexposed to equities and fixed income and overexposed to cash. So this hopefully is a time for them to think about how they can, any pullback, but in particular, this one I think is a great trigger, a great catalyst to assess allocations and perhaps move more in.
Yeah, and you talked about it there. I mean, if we're in this economy and we're looking at the market right now as it is, I mean, are we at potential of going the opposite way if everyone just decides to run and start selling? Is this going to be a domino effect on, say the S&P?
I don't think so. Again, because there is so much cash on the sidelines, so that if there are those investors who get out, valuations suddenly look more attractive, and there are those waiting in the wings to start to move in. Hopefully they have a longer term bias, because I think that's important. And again, most investors should have that long-term horizon, but I don't think that this would be a long sell-off period because of that very significant amount of cash on sidelines.
Yeah, and rate cuts looks like they're coming soon. Well, it's clear that we're in a period of significant uncertainty, but also some potential opportunity here. Thanks again, Kristina, for coming on. Kristina Hooper, Chief Global Market Strategist at Invesco, joining us today.
Thank you.
Thank you. Now, we'll be watching the developments closely, especially the Federal Reserve's upcoming meeting here at Kitco News, where we'll bring you the latest. I'm Jeremy Szafron for all of us here. Thank you for tuning in. Lots of great content coming up. Stay tuned.